Give it up for Mr. Dimitri Speck. Thank you.
Thank you very much. I will not make a joke, but I show you this this boy who is jumping into paper money and very happy. This is, of course, in Venezuela. This paper money is worthless. And maybe you are also quite happy, or at least you will become quite happy as soon as the gold price does rise because of problems in the financial system. My lecture has two main parts. One is the financial situation in which we are worldwide and how it will or might affect the gold price. And the second is the factors which usually are affecting the gold price and how they should develop, and then some 2-3 practical hints. First, the current situation is exceptional. Yeah, you see here over 200 years the yield on 10 years German government bonds. Yeah, and the yields have never been historically that low as they are currently. Yeah. This alone shows you that we are not in a normal financial status worldwide. The central banks are manipulating the yield of bonds, of government bonds, but also of other bonds indirectly, to a very low level. This is not normal. It affects not only the savers that they earn less, it affects the whole economy because first, so-called zombie companies who would normally disappear from the market, which are not efficient, can survive, and taking resources and manpower from other companies. The government, with this low yield, is spending more money. And third, bubbles do arise because it's easy to take credit and to buy any stuff. This is the means how the central banks did it. What you can see here is this central bank sheet, the amount of money, the base money in the Federal Reserve System in US, and starting from 1999. And in the middle you see the financial crisis of 2008, and since then it's rising. And that's a worldwide phenomenon. It's not only the Fed affecting, but also many other central banks, especially the European one, but also others. So we have credit bubbles everywhere, and my thesis is, which I call a mega bubble, that we are currently in the biggest bubble of the history worldwide. And first, some examples of bubbles, just to remind you that bubbles in general are not a new phenomenon. Yeah? They exist also in the past, and they always did burst. Yeah? We had bubbles already in ancient times and in ancient China. We had the very famous bubble in Holland, the tulip bubble in 1635. Two other famous bubbles were in 1720, the Mississippi bubble and the South Sea bubble. Then we had several land boom bubbles in the United States, a railway boom bubble in the middle of the 19th century in Germany. Then we had this famous stock market bubble in the late 1920s. In 1982, we have a very funny or very interesting bubble. This was in the former camel market, Souk El Manek. It's not very well known, this bubble. But at that time, this former camel market had a stock market capitalization which was the third biggest in the world after US and Japan. And practically all these companies were, in the end, worthless, and they disappeared then when this bubble did burst. Of course, we had other bubbles. Famous is also the tech bubble, which burst starting from 2000. And I want also to mention real estate bubbles, especially the one which were created through introduction of the euro, is, for instance, in Spain. Yeah, because suddenly the rates were very low, and the Spanish people could buy much more easy real estates, and we had a real estate bubble. Yeah. Many of these bubbles, or if not all, were also connected with influence from the government. It's not so that the people just are starting to make a bubble. Usually there is a governmental influence, and this is also currently in this mega bubble the case where we are. Yeah. The current bubble is larger than the previous ones, also larger than the one in 2008, yeah, or 2000. Which is important, the current bubble is global. Yeah, we don't have only a bubble in, let's say, the real estate market in the US. Yeah, we have bubbles in real estate market, for instance, currently in China. We have them in Australia, Canada. We have them in the commercial property market in US. Yeah, not everywhere, of course, but in many markets and also in many sectors. We don't have them only in real estates. We have them also, for instance, in the US stock market. I will show you soon. We have also bubbles, in my opinion, in the so-called cryptocurrencies, yeah, which are just a database entry, and for instance, in whiskey and other goods. This bubble of this dimension was only possible because it was possible worldwide to create as much debt as never before compared GDP measures. Yeah? And this was done because in 1971 the money lost any connection to gold, and in 1993, since then the gold price has been suppressed to avoid the impression to the savers that something is wrong with their savings. So let's look at the other side. Bubbles don't come without money. You need money creation, you need debt creation. This is one is the other side, one is the one side, and the other is the other side. I will show you soon. What you can see here is from 1980, the public debt in US compared to GDP. In 1980, it was about 30%. Now it's about more than 100%. Yeah, and the deficit in US especially is rising. So you see, clearly we have a huge difference now compared to several decades ago. At least so important, if not more important, is the situation in China. Here you see the total debt, meaning not only the public debt, but also the one of private households and companies against the Chinese GDP, starting from around 2000 until today. And you can see, no? Here was a financial crisis, and since then the Chinese did create the biggest credit creation in the history of the world in this speed for a big country in peace times. Yeah, the debt in China did increase from 150% to 250% in about 10 years. So 100 percentage points, yeah, in just 10 years. This never happened before for in a big country. This is very important because the Chinese did help the entire world to come out of the big recessions of 2008 and thereafter. And they did it with a lot of credit creation. Yeah? And you can easily imagine that this will stop. You can't create a debt in this speed forever. That's simply not possible. And of course, also the real estate market in China, yeah, is in a big bubble. We should not underestimate it. What you can see here are the mortgage loans in yuan from 2008, so over the last 10 years. And it's almost 10 folds. Yeah? So you can see how much money, how much debt has been created in China to buy Chinese real estates. And that means, of course, that a lot of real estate in China is overvalued. And also it's wrong invested. Yeah, because this huge amount of credit creation always go hand in hand with malinvestments. And in China, these malinvestments are, for instance, these ghost towns. These are towns with space for hundreds of thousands of people, which are practically empty. Yeah. Here's a picture of such a town. Yeah. And that means we have not only a lot of credit, which did rise a lot, but we have also many investments which will never yield to pay this credit back. Yeah. Of course, not all investments are like that. There are also many good investments in China, but there are too many bad ones. So we have a bubble in the Chinese real estate markets, but also in others. And now I show you that we also have a bubble in the US stock market, which is still the biggest in the world, with a share of about 40% market capitalization of the world. And here you see from the 1970s, the stock market capitalization in US against the US GDP. And there are two circles. The one in the middle is the top of the tech bubble, which burst then in 2000. And the second circle is the current one. The situation at the beginning of 2018, but also just recently. We had a valuation of about 150% market cap to GDP, yeah, which is like it was in the top of the bubble 2000. Yeah? And market cap is a very good measure for stocks to evaluate for the valuation of a stock market, because it directly measures the value of all stocks compared to the economy. Yeah, there is nothing in between, like earnings or whatever, which change by the economic cycle. Yeah? And you can also see, if you look here on the left of the chart, when this bull market started in the early 80s, yeah, we had about 30–35% market cap to GDP. So who thinks that we are at the beginning, or that this bull market of stocks will continue many more years? That's not realistic. Much more realistic is that we are at the end of a bubble in the stock market, and this bubble is just bursting. So this artist shows you a very big bubble. Yeah. It's not easy to make this big bubble. There we are already, and it's much more difficult to make it even bigger. Yeah. So there is a chance, a good chance, that this will burst soon. And the starting point of bubble bursting is often the central bank system. I mean that the yield, the short-term yield is rising above the long-term yield. What happened just last Friday, by the way? Yeah, the inversion of the curve. It's often caused by the rising of the short-term yields, and in this special situation, of course, through reduction of this quantitative easing, meaning the buying of bonds, or of the inversion. And we can see here in this chart, the red line is the rising of the key interest rates in US. Yeah, and the black line is the amount of bonds in the Federal Reserve System, which is going down. Yeah. So this reduces the money flow, which can create bubbles. And this is also the reason why this bubble is now bursting since the beginning of 2018, yeah? Worldwide, in my opinion. And of course, the Fed is already changing its direction. Yeah? But don't think, please, that this will avoid the stock market to drop even further, maybe even much further. Yeah? If you remember 2000, the bear market after 2000, or the bear market in 2008, also at that time the key interest rates were reduced, and this did not avoid the drop in the stock market prices. Also, if you look in Japan, where we have low yields since the mid-90s, we had also a very long bear market. So low yields can create a bull market or a bubble, even this mega bubble worldwide, or it did. But low yields are not a guarantee for rising stock market prices or rising real estate prices. This is clear proven. Yeah. And here just a picture of this current bear market, in my opinion, of the stock. Over the last 2 years, you see here the MSCI World. And you see also this recent rise since 24th of December, caused mainly through the Fed, because they gave a hint that they would change the direction. Yeah, but this is, everything is now priced in. Yeah, so we are in a bear market, which might continue much further. Now, I talked about the bubble, the worldwide bubble. And I want to make a short sidestep to the situation in Europe. Yeah, the Eurozone has a special problem, which we should never ignore, yeah, because sooner or later the euro will, the wrong construction of the euro will cause huge problems which other currencies like Japanese yen, British pound, US dollar, whatever, don't have. They have their own problems, but this problem only the euro has. You see a dark blue line here, the GDP per capita in real terms in Italy over the last 20 years. Yeah. So it did not rise. Yeah. So Italy or South Europe has a big problem, including France, by the way. These are big countries, important countries for the Eurozone. Yeah. Why do they have the problem? Because they have one currency fitting or not fitting for all. The euro is too high for those countries and too low for Germany. And you can never solve this within the euro system, at least not easily. And it was not possible in the last 20 years to solve this issue. Yeah. And this causes that countries like France or France or Italy are growing much lower than they could do normally. And of course, it causes sooner or later also political unrest, like currently starting in France, or the election of political parties, which are, let's say, yeah, not very common, not very, which are give a new tendency. And of course, it increases the tension within Europe. Here a reminder what we are talking about. The left, this is a public debt in the Eurozone in billions euro. The red one, 2,300 roundabout, is Italy, almost the same amount as France. And the gray one is Greece, 300 something. It was of course higher when the euro crisis was at its top. But you remember that the euro crisis, in the center of the euro crisis was Greece. Yeah? What we are talking now is a much, much bigger problem. Yeah? We are talking about Italy and France. So if the next euro crisis involves Italy, for instance, or the Italian banking system, or just some political issue, we have a much bigger problem than we had in the last euro crisis starting 2011, 12, something around. Yeah. So back to the main scenario. Yeah. The world is indebted. I will show you soon how much. Yeah. And debt means also, the quantity of debt is also the same amount like the quantity of money. I mean, any claims, let it be in bonds, let it be in bank accounts or whatever. Yeah. That means nothing else that any debt reduction goes always hand in hand with a reduction of money and credit claims. Yeah. There is no other choice. And here you can see from the 1950s until today, the total debt worldwide against the world GDP. I think this is the most important figure for the coming financial scenario. And you see it was about 100, 120% until the 1970s. And since then it did rise and is currently about 250%. And you can also see there is no period where it was possible to reduce this amount of debt significantly. There were some periods where it was sideways, but no reduction. Yeah. If it's not possible to reduce the debt when it's much less, of course it's even more difficult to reduce the debt at this current level. And if it's not possible to reduce the debt in a current situation where we practically have yields of 0 or 1 to 3%, yeah, then it's simply practically not possible that the economy grows out of the debt with regular paying back the debt. This will not happen. Yeah. Theoretically, it's possible, of course. Practically, it will not happen. That means we will go down here. At least 50% of the debt will be written off in one way or another. And that means also the savers will lose this amount, at least. It depends, of course, also how the history develops and how the politicians decide. What you see here is just for us a funny picture, for the people not. You see on the left the picture how much in Venezuela cost a roll of toilet paper. You need more paper to buy this toilet paper than the toilet paper consists of. Right bottom you see a man carrying money. Yeah, and in the middle at the bottom you see this guy who is a real bad politician regarding economy. Yeah. I don't expect hyperinflation, by the way. Yeah. You need really bad politicians, much worse than we have here in the Western world, to get hyperinflation. Yeah. This just before you panic and think next week we will have a situation like in Venezuela. It's not likely, and if, then it will happen not soon. Yeah. But I want to show you what direction we might go. And this is inflation. Not in the first step, but in my opinion, it's the most likely outcome. Yeah? What is more or less sure is that we will get an expropriation of savers, yeah? Because this indebtedness at the end of the cycle will be much lower to GDP than it's currently. Yeah? QE and deficits in the public households usually get over time out of control. Yeah? It cannot last endlessly. And one thing is also important. Of course, we might have a deflation. We might have bankruptcies in the banking system, for instance. Yeah? This might happen here or there, like it was the case in Cyprus, yeah, in 2013. But the standard political measure since the 1930s is always when we have a financial crisis and always when we have a recession, yeah, to print money. Let it be through the central bank system, let it be through the government, let it be both. And the chance is very high that the governments and the central banks will decide again in this direction. And in the end, if you print money, it will not be like in the last 10 years, where just the asset prices did grow. It will result that all prices will grow. I mean, strong inflation, and in the end, more or less inflation which is difficult to get under control. So let's talk about gold. We have here the Conference of the Future of Gold. Gold has a few characteristics. First of all, compared to credit-based money, fiat money, it cannot be created out of nothing. So it has an inflation protection. Then it cannot broke. This is different from any bank saving. Then, important, especially for central banks, it's independent from states. Yeah? So there is no government who can say, okay, the money is now worthless, let's make a new currency. Or let's say, Yeah, I would say soon. And this is also important. You can transfer it easy, gold and silver. Yeah, and that's a difference to other assets, which are also real, like companies or real estates and so on. Yeah, those you cannot transfer. And that means also, for instance, they can easily be taxed. The government, if it's out of money, can say to the real estate owner, okay, I increase the taxes, and you cannot run away with your real estate. Yeah, with gold, it's maybe not legal, but it's possible. So, this is the current situation where we are worldwide. It's a mega bubble. Yeah? We are indebted as never before in the world in peace times. And now I come to the factors which are affecting the gold price historically, and ask whether and how they will affect the gold price in future. What you can see here on the top is the gold price from 1918 until 2012. I didn't update this chart because it's really a lot of work to do it. Of course, not the gold price, but the line below. Because the line below, what you see there, is the amount of central bank gold which came into the market. And the central banks sell gold in the market sometimes, or are buying it, and they are leasing gold into the market, and sometimes they get the gold back. And as they don't publish these figures, it's a little bit difficult to make this estimate. But it's based on mathematical rules, by the way, not just plain guess. And you can see here that in 1993, the gold price did rise. And here, by the way, started the systematic gold price suppression. Central bank decided not to allow gold to stay about 400 at that time. Yeah, here I show also. And you can see how the central banks has done it at that time. There were two main measures to suppress the price of gold. The first was physical gold coming into the market from the central banks through selling and leasing. Yeah. And the second was sales through futures market, price shops where the gold price did drop, for instance, $30, $40 at that time, within minutes. Yeah. To show the potential investors this is not a good investment. And you can see how that this did influence the gold price, it did suppress it in the 90s, but you can also clearly see that since 2001 already, there is no additional gold coming anymore from the storage of the central banks into the market. So this is very good news. The gold suppression through sales and lease, gold lease, is history, and it will not come again, at least not soon. Then we have another systematic price manipulation. What you can see here is the intraday gold price in average over 20 years, computed out of about several million minute prices. It's intraday. You see the time scale at the horizontal axis, at the price scale at the vertical axis. The time scale is Eastern time in New York. And where you see this manipulation, this is the PM fixing in London. So it's morning hours in New York. And you can see, I have proven this, by the way, for the first time in 2001, that the gold fixing has been systematically manipulated. Yeah? But this is also history. Yeah, the gold fixing has been improved. There has been punishments for manipulating the gold fixing, for instance, for Deutsche Bank. Yeah, by the way, with the help of this chart. Yeah, I'm guilty. No. Yeah, and this is history. That does not mean, in total, that the central banks will not try to suppress the gold price again through the means of future sales. Yeah. But it will not sustain anymore, this suppression. And there's even another central banking influence factor which could affect the prices, the buying of gold for central banks. Central banks are not a monolith block. Currently, about 2/3 of the central bank reserves are in US dollar bills. Yeah? Historically, this was quite different. Historically, gold is a store of value for central banks or for states if they make trade with other countries. You can here see the share of gold in total central banks reserves since 1880 until today, and it was always about 90% and is currently about 12%. What does this mean? It means in case the US dollar inflates, yeah, or the US dollar drops, the central banks will lose a lot of money and they will have an interest to invest in other assets, and a lot of that will be gold. And the second is, the more the US is using their power, for instance, to influence other countries through means like sanctions, yeah, other countries will have the interest to sell their US treasury bills from central bank reserves. Especially Russia is doing this all the time already, yeah? But other countries might follow. So central banks will be buyers in total in the coming years. The next big influence factor is negative or low real interest rates. You see here from the late 1960s until today the price of gold at the top. And at the bottom you see the interest rates in US minus inflation, so the real interest rates. And these yellow areas are the periods where the real rates were low. And you can clearly see at that time did gold rise. This was in the 70s, and this was starting from 2001 also. But you also can see, and I have marked this with 2 circles, that in between there were periods where the gold price did drop despite low real rates. Yeah? This was in the mid-70s when gold price did drop from 200 to 100, and it was after 2011 when the gold price dropped from about 2,000 to about 1,000. Yeah? So this can happen, and this does not mean that the gold bull market is over. I show you here the connection between gold price and stock price. Because when can it happen easily that the gold price does drop despite we have low real rates? Yeah? And these are the left circle. This was the 70s. You see here in gold color again the gold price, and in blue color you see the stock market index for the US. And you can see that in the mid-70s, when the gold price did drop, despite low real rates, the stock market did rise. So this is just a switch in asset classes, meaning as long as the stocks are rising, they attract investors' money, the money goes into the stock market, yeah, and leaves the gold market despite low real rates. And the same situation, this is the right circle, a similar situation we had after 2011, a bull market in stocks. Yeah. So, the future of gold price. Okay. The suppression of the gold price is not lasting anymore long. Yeah. They will try again, but they will not suppress this. Gold typically rises in low real rates in the environment, except if stocks are rising, which happened after 2011, and which is over, in my opinion. It's quite clear that the stock market, especially in US, is at its limit. So gold will continue to rise for the years to come. Yeah, not only a few months, but many years. Yeah, the gold bull market since 2001 is quite similar to the one in the 70s, but lasts 2.5 times or so longer. At the 70s, everything was much quicker. Yeah, And in the end, the gold price will exaggerate much. Yeah? We have here the chart of the gold price since the 1970s. Yeah? And you see that we have, what is wrong? Okay. It was 2 periods, yeah, and now we have one leg of this gold bull market. And it was much quicker in the 70s, so expect that it will take much longer, the second leg of the gold bull market, than it took in the 70s. This was in the 70s, the pictures, yeah. It did rise from about 100 to 850. This corresponds to from 1,000 about to 8,500. Yeah. But as we are much more indebted than in the 70s, I expect a higher price at the end. Let's talk about silver. Yeah. On the bottom you see, on the top you see the silver price since 1919. On the bottom you see the ratio of silver to gold. And always when it was low, yeah, silver did rise. And it did also rise, this is marked with arrows, compared to gold. The reason is very simple. When we have bull market in precious metals, yeah, silver has a tendency to rise percentage-wise much faster than gold. Yeah, because the stock, there's much more stock against the flows, meaning consumption and production in the gold market, than it is in the silver market. So in this regard, silver is a better investment. Here in short, platinum. Yeah, you see in blue platinum and orange gold. And historically, here's a ratio, maybe it's simpler, starting from the late 1970s or late 80s. The ratio of platinum to gold is much lower than it was just a few years ago. So also platinum is interesting compared to gold. We are talking here about 4 times fold. And of course the mines. We have here from 2000 until today, the ratio of gold mines compared to the gold price. It's also quite low, and typically when it's so low, the gold price does rise. Good, then I come to 2 practical hints. This is a seasonality of the gold price. This is the average tendency of the gold price since the last 50 years. And you can see that the gold price typically, no, you can't see, sorry.
You have 5 more minutes.
Sorry?
You have 5 more minutes.
Oh. I did faster because I had the
No, it should
feeling.
be okay.
Good, thank you very much.
5 more minutes, then we go to questions.
Yeah, okay. This is a seasonal chart. That's not a normal price chart. And you see here the seasonal tendency of the gold price. At the bottom you see the calendar from January to December. And at the vertical axis you see the price information. And gold typically rises in the second half of the year, yeah, marked with this arrow. The reason is demand for Christmas, for instance, or for the wedding season in India, or for the in China in February there is a season, and so on. And now we are in the middle of March. I have marked it with the circle. Here's a temporarily seasonal bottom, so it's also currently a good time to buy gold. Yeah, this is done, by the way, from Seasonax. I have flyer here. Everybody who is interested in seasonality or other factors, calendar factors who are affecting the prices, not only of gold, I have some flyers here, you can have them. And this is another point. This is the tendency of the gold price within the week. You can see from 2000 on until not today, but just recently, how the price was during the week. In black, you see the gold price, and in blue, you see the annualized performance of the weekdays. Yeah, and you can see here a very clear pattern. Gold does typically rise from Thursday closing to Friday closing. There's most of the performance, and in average, and then other 4 days, there's almost nothing. Yeah. So if you buy gold, you do better if you are doing an average. You do better when you are doing it on Thursday and not on Friday, please. Yeah. Before the price does rise in average. So put all together, if I would invest today, I would buy physical gold, that's clear. Also silver. Silver is more costly, of course. You have a bigger bid ask, you have higher storage costs. But from the price perspective, silver has a much better chance compared to the risk than gold itself. Yeah. And regarding here, we are here in the Eurozone. Yeah. I think it's not that good to have big euro investments. We have here a special risk. Nobody knows how this will turn out. This is a new history, but it's very likely that it will cause problems. And there are some countries, only a few, I mention here Norway, which are not indebted in total. Yeah. So, and they are not Eurozone, so why don't, if you want bonds, why not bonds of the Norwegian government? Yeah. Of course, my opinion is, especially in the US, the stock market will burst. There are some countries, like Russia or so, which are not overvalued, but US, which is the main market, is then platinum and some gold mines. And I come to the end. I have written this book, The Gold Cartel, published by Paragraph Macmillan. It's also available in German and Chinese, so you can choose. And I have developed, I also already mentioned it, this website Seasonax, where you can make seasonal statistics and much more. And if you have Bloomberg and Thomson Reuters, you can make even much, much more than just seasonal statistics. And I have also awarded a prize there. And thank you very much for your attention.
Very good, thank you, Dimitri. Now we have the floor open for questions. We have 15 minutes. So whoever has the gentleman over there, Guido, over there. And we'll give the mic to you.
Hello? So, do you agree with the statement that the dollar is strong and is going to be strong in the future?
Yeah, to be honest, this I don't know. Yeah, we are in a situation which is historically so singular that the specific timing, how the financial system will fall in parts, is not known. Yeah, so the main thesis of this dollar bulls is that the money will flow in US, for instance, if there is a euro crisis. Yeah, but in my opinion, it can also turn out with other priorities. For instance, it can be that the dollar will inflate first. This I simply don't know. I think we can just observe the market, how it will develop in the coming months and years, and then we will see.
Thank you anyway for your interesting presentation. You didn't mention rhodium in your speech. Do you have an opinion on that?
Practically, it's quite difficult to buy rhodium. Once we wanted to make a product for institutional investors for rhodium, and it's quite difficult because the bid ask is very big, and there are only 4 or so main players, and if there is some demand, immediately everybody knows. So I didn't had followed this market anymore since then, to be honest. Yeah, since I tried to make a product.
Mr. Speck, thank you very much. Very, very interesting. You've spoken about a bubble of stocks bursting. What do you think about bonds? Do you have an opinion, a formed opinion about a bubble in bonds bursting after this 30-year bull market?
First, it's quite popular to talk about a bubble in bonds, but I think it's a wrong term. Before we had this low yield environment, nobody used this term bubble for a plain financial asset, which is just a claim. Usually bubble, you are using this word for something real, like real estates or stocks or whatever, and not for, yeah, okay, but even if we use this term, as I mentioned, all these claims, financial claims in paper currencies, will get, at the end of the circle, will become not totally worthless, but at least 50% worthless. So what the way will be is in question. What we can already see is that what the central banks did in the last years through low yields does not lead to the outcome, which would be a positive outcome, that the debt of the world does decrease. Usually it could be used. If you don't pay 5% interest rates but 0, you could use 5% of the amount to reduce your debt every year. So after 10 years you would have much less debt than before. But the very opposite happened. The low yield led to credit creation, and more indebtedness. So my thesis is we will get some kind of devaluation of the savings, at least 50%. In my opinion, at the end, it will be inflation. And of course, inflation goes hand in hand with rising yields. But in between, we can have lower yields, what we just saw in the last months.
Hello, thank you very much. Why would a state like Norway, if they have so much money, make bonds?
Excuse me?
The state of Norway has no debt, but why would they give out bonds?
Sorry, I shortened this a little bit. There is a public fund, a pension fund in Norway, which is the biggest public fund in the world. And despite that, Norway has also some debt, but not much. And I put it together, which is legally not correct. But you know how the world is. If the government would run out of money, they would take from the pension fund, of course, the money.
And there was a question over there. Last question, maybe. And here.
Thank you for your good presentation. I heard from several speakers that the financial system is on a collapse, but I'm a little bit lacking how will the new financial system look like. Are we going back to the gold standard, or what do you think?
I think gold will play a much more important role, especially in between states. What we had, that the US dollar is a currency reserve of practically the whole world, including potential advisories like China, is a very singular event in world history, in my opinion. So, in my opinion, the central banks will have much more gold than now, or at least the value will be also much more higher. Whether we will get a gold standard, I think no. The reasons are, I think we will get another credit-based money system. But this, I think, nobody knows. We can talk about this in 10 years. It depends also on the price level of gold, how the gold is shared between countries, whether there is one nation like currently the US who dominates the world, or how it will turn out. Depends on a lot of factors, also political factors, mainly political factors.
Is there a question over there? No. Last question here.
So you touched on two things that are commonly said. First of all, that all the problems started when the gold standard was abandoned, which I agree with. And then the second point that's made is that the problem with the euro is that there is one currency which is not right for all the members of the currency zone. How do you square these two positions? We say, well, if Greece had a separate currency from Germany, then everything would be fine. But on the other hand, the best system is gold, which would mean this whole same currency for the whole world.
This is just an historical process. Yeah? One currency for all is no problem. But if you have, like it was in Italy or Greece, a currency which devaluates all the time and which is yielding with 20%, and then you make a common currency that the yields are dropping, then you have a problem. Yeah? Otherwise you would not have. So the euro is not in general wrong, it just comes for Italy, Greece and other countries 20, 30 years too early. Or came too early. Yeah. You must first have over 20 years or so the same level of yields in all countries, like you had on the gold standard more or less, except of the risk component of the yield, of course. Yeah? And then you can join the currencies, no problem. Yeah. But this was by far too early. It led to low yields in countries like Greece or Spain. In Greece we had the public sector bubble. In Spain we had the real estate bubble. We have too high incomes. We have a too big share of the government compared to the whole economy and so on. This all results from a too early Europe. Let's put it this way.
I have a last question from Guido, but his English is so exquisite that he is embarrassed to speak. And I will translate it for him. It's a simple question. Why are central banks buying so much gold right now? If they control the system anyway, why would they have to buy so much gold?
First of all, they don't buy a lot of gold yet. It's mainly Russia, Turkey, a little bit China. Yeah. Second, we have this is a political system issue. We have the US with the allies in Western Europe, for instance, which are also not that much allied in the financial regards anymore. And the US is, of course, most interested that the gold price does not rise. Yeah? But other countries are interested to buy gold. Yeah? And by the way, if you want to buy gold, like China, you are also not interested that the gold price rises, because you have to pay more. So if China observes the US suppressing the gold price, it's fine for them. So they are sometimes in the same boat, despite their economically and so on in a different boat. Yeah. But the central banks started buying gold, and this is just a little amount compared to what will happen. Yeah. It's really mainly 3-4 countries yet. There's much more to come, in my opinion.
Okay. I think on that note we can end this presentation. Is there any more ideas or questions? Well, then I would like, oh, sorry, one last question. I will repeat your question.
The central banks will start buying from whom?
From who will the central banks start buying, if they do start buying?
Yeah, if the price does rise in gold, there will come gold into the market. They just buy it. Mm-hmm. From the market, I mean, we don't know exactly how much gold is in the world. It was 180,000 tons of gold in the history of mankind. Some, I think 70 or so, is available in bars and coins. More gold can be available if the price does rise. Then the people will sell also these things. Yeah. And so there will be gold. It's also a matter of price.
Okay, so I would ask for a last round of applause for the meeting. Thank you.